Well, hello everybody. Welcome to the Idaho Partners for Good Breakthrough series, and we are very thankful you chose to learn with us today. The Breakthrough series was designed to bring people together to help develop stronger, healthier, and better equipped nonprofits. Each month, we invite experts that help us grow professionally while helping you better understand how the Idaho Partners for Good model can help transform our philanthropic sector. We strive to design experiences that are different, a place where people can't wait to come together, talk, and dream big. And we invite you to join us on this journey. We have events that we do every month, and we have a couple interesting events coming up, which I'm going to show you now. Thank you, Lisa. We have Megan Hudson talking to us about adaptability quotient. We are still deciding on a month for that. And Blossom is going to talk about the state of giving. That also we are going to decide when. So check out our website and you can sign up for all these events. And there are other ways you can connect with us. Lisa, if you can go to the next slide, please. You can follow us on LinkedIn and Facebook. We have a newsletter which we send out to everybody where we talk about everything we are doing. You can sign up for that. And if you have other questions, you can always email us. We are always ready to talk to you. And that's the email we have for you to reach out to us. And with that, I'm going to introduce today's speaker. Lisa Cooper is the founder and CEO of Figure Eight Investment Strategies, and she brings the heart of a change maker to her 20-plus year career in finance and investing. Raised in a politically active family, at age 5, she attended her first peace rally, and later, as a Wharton MBA, studied models for effectively blending advocacy and business to create social change. As a professional, Lisa has managed multi-million dollar portfolios for high net worth and institutional investors across the country at Smith Barney Asset Management, Trillium Asset Management, and Wells Fargo Nelson Capital Management, using her expertise in sustainable and impact investing to deliver both financial and social returns for clients. In 2014, Lisa briefly stepped away from investing to co-found Global Talent Idaho, an initiative to help skilled refugees and other new Americans reclaim professional careers. This work inspired her to start Figure Eight, which carries out a vision to build and protect wealth for all investors while catalyzing global social, environmental, and economic impact. When she's not investing for change, Lisa can be found hanging out with her husband and almost teenage daughter, or running with her dog in the Boise foothills she loves. And I also found out that Lisa and I are neighbors, so maybe I'll run into her someday. Welcome, Lisa. We are so excited to have you with us.
Oh, thank you. And I realized that that was written a while ago because my almost teenage daughter is 17 and we were just talking about that she's headed off to college. So time to update my bio. Thank you so much. So it is just lovely to be here today and on a day when we're recognizing or honoring Juneteenth, our new holiday. Wishing everyone a good one. And it's a great day to be talking about impact investing. And before we launch into that, I want to talk just a little bit about the work that we do at Figure Eight, because the comments I'm going to be sharing are very much from an investor's perspective. And so just a little bit more about what Figure Eight's all about. And we're a registered investment advisory firm here in Boise. We are independent, we are employee owned, we're a B Corp. We just celebrated our 5th birthday, and we manage about $130 million for clients across the country in 20 states. We've grown very quickly, we continue to grow quickly, and we are fully dedicated to doing sustainable, responsible, and impact investing, which honestly is a mouthful to say when you're at a cocktail party, whatever. But I say that because our field really has sort of an identity crisis. We don't know what the heck to call ourselves. And this becomes important when we're talking about impact investing because we really need to well, it's very helpful to know what impact investing is and what it isn't. And because of our identity crisis in our field, we often use terms interchangeably that really mean sort of different things. So I mentioned this acronym, SRI, Sustainable, Responsible, and Impact Investing. When I started in this field almost 30 years ago, SRI stood for Socially Responsible Investing, and our field is so wise to keep the acronym and change what it stands for. So Sustainable, Responsible, and Impact Investing are basically variations on a theme. So I'm going to go through those with you now. Sustainable investing essentially means using social and environmental factors to make smarter investment decisions. It's something the traditional investment world didn't like to look at anything outside financial factors, but now there are an awful lot of investors wanting to do this because they believe it makes them smarter. The primary motivation for most folks doing sustainable investing is to do just that, to be smarter, to enhance risk-adjusted investment returns by looking at things that other investors might not be watching. The R stands for responsible investing, and responsible investing is sort of the oldest, sort of variation on this, on the SRI model, and it essentially means wanting to invest in a way that's aligned with your values. And so, lots of people think that's what SRI means overall, that it's all about, investing in or not investing in certain things to make sure they reflect the things you care about. And so a good example of that might be someone who's, an investor who's deeply concerned about health, not wanting to own tobacco, an investor very concerned about climate change, wanting to avoid investment in fossil fuels. So that's the responsible investment piece. And impact investing is really all about wanting to make a difference. And so the definition of impact investing is intentionally seeking to direct capital to create social impact right alongside a financial return. We're going to dig into that a lot more. But before we do, I just want to say that this is kind of big. This is a chart of the growth of the field of SRI over the last few decades. And what you can see is dramatic growth, much faster than the rest of the asset management or investment management field, where today now 1 out of every $3 under professional management in the United States is invested with the S, the R, and or the I, and continues to grow very quickly. So now we're going to dive into more about what impact investing is. And this is a definition that comes from an organization called the Global Impact Investing Network, which is one of the homes for impact investing. And the definition is this: investments made into companies, organizations, and funds with the intention to generate measurable social and environmental impact alongside a financial return. There's a lot there. Important to recognize that impact investing really has two parts. It's the social impact piece and the financial return piece. Need both of those elements, both done in an intentional and measurable way. And we can see a deeper look into what this means by looking at this chart. There's a lot here, so I'm going to walk you through it and give you a couple of examples. I love this chart. It's from an asset manager in the UK, Bridges Fund Management. And this is basically a map of, we call the spectrum of capital, mapping different forms of capital in relation to how they look at financial return and social impact. And so I'm going to take you first to the two ends of this spectrum. The first end, this side, is traditional investing, which prioritizes financial outcomes, market rate returns, without regard to social impact at all, right? The other end of the spectrum is philanthropy, and Idaho Partners for Good, there's lots and lots about that. And philanthropy, though, interestingly, when you're wearing your investor hat, philanthropy does not involve a financial return. And in fact, it's a negative return. It's by definition a negative 100% return, right? If I give money to an organization, may have very high impact, but a negative financial return. This spectrum is all about the stuff in between those two, finance only and impact only. And it turns out there's a tremendous amount of opportunity for thinking about creativity, innovation, doing both those things and balancing them in different ways in this space. And this chart is so lovely because it maps out the S, the R, and the I that we talked about just a minute ago with some nice examples. So if we start on this end with traditional finance-focused investing, responsible investing is arguably next on this spectrum, where basically you're taking traditional investing and just saying, there's a bunch of stuff we're going to not own to align with our values. That's the R. Sustainable investing might take that a step farther in saying there are factors we can look at around social impact, around environmental impact that can make us smarter investors, and that helps inform our investment decisions. And then we get into the realm of what's called impact investing. And these are using directing capital in a thematic way, or in what Bridges is calling an impact first way. Where you say here's a problem where I think capital that has a return attached to it can make a difference. And I really want to be able to do that to solve this particular problem. So I'm going to give you an example of how that might work around climate. For an investor who's very concerned about climate change doing responsible investing, again, the focus might be on just making sure that you don't have exposure to fossil fuels in your portfolio. A sustainable investor might say, I want to be smarter. I think there's going to be a cost to carbon, either through a carbon tax or through carbon markets, and I would like to have less of a carbon footprint in my investment portfolio. I'm going to tilt my portfolio to be more carbon friendly, or carbon unfriendly, I guess, or climate friendly. That's the way to say that. A thematic investor might say, I really believe that we need clean energy. I want my capital to go there. I want to invest in that and help boost renewable forms of energy, solar, wind, geothermal, et cetera. And an impact first investor might say, wow, I can really see the impact that community solar might have in a particular disadvantaged community. That would lower the electricity costs for the residents living there. If we could get that capital into this community to build solar installations, we could all benefit from both a financial return and a social return. So there's an example of, or there are some examples of how sort of we look at that spectrum. And so you can see again that there's lots of room for all sorts of things to happen here. The state of this is that all of these things are growing again very quickly. And there's some really fantastic and impactful, wonderful things happening in impact investing. There are also some things that are not quite as great, right? So there's certainly some sort of greenwashing and some funds that say they have a lot of impact, but in reality, that impact may be sort of after the fact, or may actually be, sort of slapping some nice statistics around something that isn't really truly additive. And the other thing that's happening a lot in this field is that there is some creativity and innovation that simply has a ton of risk attached to it, and wouldn't be appropriate for a lot of investors other than those that have the very highest risk tolerance. And so it's really important as an impact investor to make sure that you're doing your due diligence around those things and that they fit for, and they're appropriate for the type of investor you are. So we can talk more about that later if you'd like to. But so as we look at where we're going to be creative in this space, what impact investors are using, and What a lot of nonprofits and corporations are using to frame their social impact are the UN Sustainable Development Goals. And I'm guessing that the folks at Idaho Partners for Good are very familiar with these. This is a set of 17 broad goals that have been developed by the United Nations, and they range from things like no poverty to gender equality to responsible consumption, like water issues, land issues. And what I would love to do right now is dive into a couple of specific things and talk about how impact investments play in those themes or related to those specific goals. And because it's Juneteenth, I'm going to focus on reduced inequalities, number 10, along with some other things that fit for this specific type of investment or impact investment, which is investing in what are called CDFIs. CDFI stands for Community Development Financial Institution. And these are organizations that lend money into communities, invest money into communities that are historically disadvantaged, that are low income, low wealth, in urban areas and rural areas, and with a real eye on racial economic justice. There are about 1,200 CDFIs across the country, some of them very large, some of them quite small. In Idaho, we have 5 or 6 of them, but 2 of them in particular are larger and bringing real, significant capital to the state in different ways. CDFIs tend to also focus on specific issues like small business development or affordable housing. And that's exactly what we see here. And a lot of CDFIs help to finance their work by attracting capital from investors, both institutions and increasingly individual investors, particularly for those larger CDFIs. They've been around for about 40 years, and it's just in the last few years that CDFIs have really come to the sort of the notice of the public. A lot of cool things happening there, and during the pandemic, CDFIs were absolutely, sort of heroes because they already had the infrastructure to get money into communities on the ground. They had the infrastructure and the trust of those communities to be able to work with folks to get capital to where it wasn't flowing through banks and other financial entities. So you get a break from me talking now for a minute, because I'd love to play a video of one of the CDFIs talking about their work. This is Capital Impact Partners, which is based in the DC area. It's a CDFI in which we invest, and I'll talk more about that in just a minute. And they work, as I said, they're based in the DC area, but they also work in other large cities, Detroit, Oakland, and a few other places. So this is starting with their CEO, Ellis Carr, talking about their work.
Equity and social justice are 2 pillars that the CDFI industry was really founded on. And I think it's important for us not to forget that. Because we happen to be financial organizations or financial institutions, oftentimes we get jazzed up about talking about the deal. But I think it's important for us to keep in the forefront that equity and social justice, the things giving folks access to services, housing, etc., is paramount. My name is Ellis Carr, and I'm the president and CEO of Capital Impact Partners. So Capital Impact Partners is a national nonprofit community development financial institution based in Arlington, Virginia, with offices across the country. Our mission centers around helping people and communities break barriers to success. And we do that by lending to, investing in, and developing programs for underserved communities across the country. I think we have taken a lot of time to be thoughtful about how we want to use our tools, and that's lending programs and investment, and really helping to increase the equitable access for healthcare, education, food, and housing. And that takes on many forms. It can be our support of a community healthcare center in the Bay Area. And in a place like Detroit, it's really helping to really further our efforts in terms of inclusive growth, thinking about how we can address and create density in the city that's lost population, and really help to deconstruct the poverty that has been a challenge in the city. Our tool set is helping to level the playing field. For me, it's important for us to understand why we're here so that we don't box ourselves in, and that we can think broad and holistically about what we're trying to accomplish. And two, we can be thoughtful about the partners that we're going to need going forward, which are going to be inclusive of the CDFI sector, but also outside of it. Because the challenges that we're trying to address are systemic and they're intractable. And so we need to be innovative and expand our partnerships beyond where we normally have.
So that's Capital Impact Partners, and they're one of the larger CDFIs, doing wonderful work. And they have actually issued debt instruments, community investment notes, that have been rated as investment grade. And you can actually buy them on the fixed income trading desk of most major brokerage firms. And that started happening about a year ago. So they're really able to increase the amount of capital that they're raising really significantly. And it turns out that there are actually 9 or 10, maybe 11 now, CDFIs that have been rated by either S&P or Moody's as investment grade opportunities, and that are issuing similar types of bonds or notes in the marketplace for investors to be able to access very easily. LISC is another one of those. LISC stands for Local Initiative Support Corporation, and they're getting capital into 45 different states. They're almost an umbrella type of CDFI. Those 45 states include Idaho, where they've invested a couple $100,000, mostly in affordable housing projects here. So Capital Impact Partners and LISC also are African-American led. And as I said, a lot of their work is very focused on improving racial economic justice, where we still have a tremendously long way to go. They're sort of the establishment CDFIs. And as I said, we invest in them and lots of other investors do. A smaller CDFI is Hope Credit Union. Hope Credit Union is a credit union like the credit unions that you know, but they're operating in the Deep South. They're based in Mississippi. They also work in Alabama, Louisiana, Tennessee, and Arkansas. In many of the communities where they have branches on the ground, they are the only banking institution around. They play an absolutely incredibly important role in providing services and access to those services, access to capital in areas that have been absolutely just blighted by financial services generally. You can see on these statistics that 46% of their customers previously were unbanked. So a real indication of how important they are. Hope Credit Union couldn't do what it does without attracting capital from outside their region where they operate. And one of the ways in which they do that is they create something called transformational deposits. They're basically CDs. They're federally insured like any CD would be. They are, in this low interest rate environment, they are slightly below market. So the things that I was talking about before, LISC and Capital Impact, those notes trade as just as any other bond would at market rates. This is intentionally sort of catalytic and slightly below market, but with the idea that a little bit of capital here revolves, has a financial return, a little bit less than you might earn elsewhere, and packs a big punch in terms of social impact. And then we can talk about CDFIs operating here. As I said, there are two larger ones. There is the Idaho, Nevada CDFI, and I meant to look up before we did this what they've changed their name to. I don't know, Lavanya and Blossom, if you know that name. I can't think of what they've changed their name to recently. So that's one, and they work mostly in commercial real estate, community infrastructure, and affordable housing. And the other is MoFi. I actually sit on the board of MoFi. MoFi is not an acronym. It's just a shorter name than their old name, which was the Montana and Idaho Community Development Corporation. So they needed something shorter. And MoFi really focuses on small business development and something called New Markets Tax Credits. I'm going to focus on the small business piece, where they have a revolving loan fund that gets capital into the hands of small business people. If you walk around downtown in Boise, you will pass many restaurants and shops that have been customers, basically, of MoFi, that have gotten loans from MoFi and technical assistance from MoFi. MoFi, like so many other CDFIs, is an absolute hero through the pandemic. Even though MoFi is I should paint this picture, MoFi is a smaller CDFI. Still, their revolving loan fund has $40–50 million in it, something like that. So that's a sort of mid-sized CDFI, probably, in the scheme of things, much smaller than Capital Impact Partners or than LISC. But even with that size, MoFi wrote 5% of all PPP loans that were made in the state of Montana, which is huge for a little nonprofit. Folks there worked almost round the clock to get that money into the hands of struggling restaurant owners and shop owners and types of services. And they've issued promissory notes in which some of our clients are invested. They are not publicly traded, so those are things that take a bit more work on our part as an investment advisor. But we do a lot of that work into smaller CDFIs for our clients because we know it's hugely impactful. It's one of the brands of impact investing that we, sort of specialize in, and we feel very confident about their balance sheet, income statement, all of those things. So those are some examples of the types of impact investments that are, we believe, accessible and appropriate for individual investors, for nonprofits, for endowments, for investors who are not in the hundreds of millions of dollars of investment that institutional investors typically are putting into the markets. And then I just want to give you an example of how this looks in an actual client portfolio. So this is the work I do, and I and my team do all day long. So here's an example of a client who is a person who is an Idaho resident, who's retired and has had the benefit of being able to earn and inherit and save about $4 million. That's the size of this portfolio. And the portfolio is allocated across pretty traditional types of asset classes: cash, a little bit, fixed income, a little more than 30% of the portfolio, equities or stocks, a little more than 60%, and a little bit outside public markets in what we call alternative investments. I want to show you in here where the impact investments we were just talking about fit. And they fit in the fixed income or bond portfolio, which is about $1.3 million overall. And you can see that that's allocated to some government and corporate bonds, to some municipal bonds, which this client, well, they're very appropriate for her. And also she's very interested in municipal finance, and a little more than 40% in these impact notes. Here's what it looks like in her actual portfolio. And I want to point out a few things here. This is just a snapshot of a piece of this overall portfolio. First, I want to point out that you can see some of the entities that we were just talking about. Here's the Hope Transformational Deposits. Here are 2 Capital Impact Partner notes. Here are 2 LISC notes. And here's MoFi with its old name, Montana and Idaho CDC. As I said, all of these are market rate other than the Hope Transformational deposit, which is slightly below market. The other thing I want to point out, sort of cut off the headings here, but this is the percentage of the portfolio that's invested in each of these instruments. And you can see that they're pretty small numbers. So Hope is 0.6% of this overall portfolio. Capital Impact Partners, between the 2 of them, is about 1.3% of the overall portfolio. And that's very intentional, because as much as we believe in these organizations, and as much as we have the assurance of S&P or Moody's rating some of these as investment grade, we don't want to put too many eggs in one basket. It's a way that we manage risk for our clients. And it's a way in which, as we think about impact investments, it's really important to think that if you are, as we think about individual nonprofits issuing different types of impact investments, there is real power in sort of pooling those into a fund, so that that instrument comes with diversification, and thinking that that's going to fit in someone's portfolio as a piece of their overall portfolio. So let's see. So recognizing that it's now a holiday weekend, and that I've been talking at you for half an hour or so, I'm going to stop. I have a little bit more that I'd be happy to talk with you about, but I think I'll stop there and see what questions you have, or any conversation anyone would like to have, and take it from there.
Lisa, I have a question. So when you were showing the map, the spectrum of capital,
yeah,
I was trying to call up some of our local B corporations.
Mm-hmm.
So, and the first one that came to mind was IndieDwell.
Mm-hmm.
So where would they fit? Are they an impact first investment?
Well, I actually don't know the answer to that. First, I'm going to say that. They are, I know that they have been seeking investor capital as a social enterprise. And I know that there were a number of funds looking to invest in them, right? So larger funds that have an impact mandate that were looking to help build affordable housing. I don't know what investments were actually made. So I can't speak to that about exactly where they would fit, but most likely those funds would have been either thematic or impact. Probably if they were coming out of foundations or out of CDFIs, they probably would have been called impact first. But again, I don't know if they would have sort of been positioning the structure of that financing at market or at a concessionary below market. You see all sorts of creative things happening around there. I also don't know if they were attracting debt capital or equity. Lots of ways to play this, and they may have been doing a whole bunch of different things. So for me as an investor, or as someone running an investment firm, if I was looking to place an investment in something like IndieDwell, I would be looking for most likely a diversified fund, or CDFI pools are basically funds that have an affordable housing mandate, and that carry certain risk parameters and return expectations with them that would fit for our clients. And that would probably fit in either of these two categories. Does that help?
It does. So my next question is around educating your clients. Mm-hmm. This is fairly new, this field of impact investing. And so is it more likely that someone who is younger, that they're going to jump on this type of investment in a lot more than someone who's older and much more used to a traditional method of investments?
So I would say that the demographics of the typical impact investor are either that they're older or that they've inherited a great deal of wealth, because most of these instruments are available or appropriate to use once you have enough capital to allocate in a way that you can kind of manage the risk appropriately. And so a lot of younger investors want to do this type of investing. And there are a couple of vehicles that are available at lower minimums. And in fact, some of the CDFI notes you can buy in increments of $1,000. But most of those are, they're not widely known among individual investors. So, usually someone who's already working with an investment advisor who knows about those, and in the investment advisor is placing that, again, it sort of skews towards people who are higher or have higher net worth, higher investable assets. I think that will change over time. I'm excited about it changing over time. And so, we in the field talk a lot about the democratization of impact investing, but I would also say that we're not there yet. Any other questions? Great. So I think, I guess what I want to say is I'm around. And I absolutely welcome, more conversation and Blossom. I know we talked a little bit more about trying to spur some of these things in Idaho and maybe more issuance of securities or of inclusion of Idaho entities in impact investing. And I really look forward to that conversation. I think there's a ton of potential. So thank you for the opportunity. It's delightful to be here with you today, and a good Juneteenth to everyone.
Thank you so much.
I'll ask the people that are on the call, is there anything in particular that piqued your interest about this topic that you thought, well, I really want to understand X, Y, or Z? So is there something in particular that you were hoping either would be addressed or that you could understand deeper as a result of this presentation?
I really liked the investor perspective. I get a lot of this conversation from the company and like, what do they want in exchange for capital, or like, what are they willing to offer? Things like that, like the company's perspective. And we talk about these, so-called impact investors that are just out there looking for businesses like us to invest in, as though there's some sort of, mystery person. So I was excited to hear it from, what is the investor looking for, and the way that they think about it is helpful for communicating to clients, business clients.
So Lisa, are there investor mindsets that you try to cultivate?
Cultivate, maybe, I guess, yes, that, an understanding of risk and appropriateness. Those are really important things, especially with younger clients. I think, most of the folks who come to us, are seeking a couple things. I mean, one is that they want to know that their money is, doing good in the world and not doing harm, right? Those things. And so they're sort of looking for someone to walk alongside them to make those decisions along the way, because, none of this is 100% clear cut, right? So, so I think, there's absolutely that piece. And the other thing is we have clients who are, sort of early in their investment work, who are smaller clients, or have just come into some wealth for whatever reason, and they're newer at this. For them, there's lots and lots of educating. And especially for the clients who are newer or earning and saving money, knowing that their money is also working for them, while that those two things are going hand in hand, that they're getting good returns, and that they're able to grow their money to be able to take care of their families and send their kids to college and eventually retire. Those things are really important. We also have clients who know that they have enough, and in fact, they have beyond enough. And they're, they come to us with this question of, now what? Because everyone else in the financial services world, that in their worlds, their traditional worlds, is telling them, protect that fortune and pass it along to the next generation. And, we'll do some estate planning. We'll make sure that we, help you minimize your taxes and all of those things. And the conversation we have with them is very different. It's, there are things you can do with your capital to create change. Let's think about that purpose. In whether that's redistributive, and thinking about you giving money away, maybe during your lifetime, maybe, looking for the biggest bang for your buck kind of in terms of impact. Or maybe, we increasingly work with clients who say to us, you know what, I want to know that that money is there if I need it. I want to leave something to my kids. I want to know that if I, need long-term care, that I've got it. But I also don't need it to grow. I just need to keep up with inflation. And so we're increasingly doing work for clients where we're keeping in the investment pool, the risk pretty moderate. The return expectations are moderate. It's not growth at any cost. It's not growth. It's just keep up with inflation, and then work the heck out of the impact. And we're doing a lot of that for people now. And that's very exciting to me, because it's very different from the mentality that most of our field has, which is more is always better. I don't know how we fix the intractable problems that we have in the world if we keep that mindset. So I guess if your question, Blossom, I so appreciate around cultivating that. I think, I don't know that we're so much cultivating it as legitimizing those feelings and saying, yeah, that, here's a path, let's figure it out together.
So I have a question, Lisa. Sorry, Blossom, you were going to say something.
Nope, go ahead.
So what do you see as one of the bigger barriers to impact investing?
Barrier for an investor, or barrier for the growth of the field, barrier for raising capital?
Barriers for investors, barriers for people to, more people to invest in impact investing.
Oh, I think I think there are a couple of things. I think one is that that there aren't enough investment advisors that understand the field and know the landscape and the possibilities that are out there. There also really has been more capital chasing deals than there have been deals, kind of up until pretty recently. And I think there are lots of reasons for that, but I think that that's, for a while, even the CDFIs or other institutions would say, we can only handle so much capital. Our capacity to get it out to communities or to entities like, to enterprises is limited. So don't send it here. You're not ready for it yet. I think that there's been, a lot of development there, but, for a long time, there's been more capital seeking deals than there have been deals. Again, I think that balance is sort of righting itself. So, and I expect there will probably be other mismatches through time as more and more investors want to do this, and more advisors, become very familiar with the space. There will be more demand, and then the supply will have to catch up even more. But, I do think that's happening. So I guess one other barrier is or one other place where I think there could be some missteps is, there have been some really egregious things, funds set up, capital invested, in a way that's created really some negative impacts. In particular, loans that are loan funds that have made loans at really exceedingly high rates to needy folks, and that certainly happened in the microenterprise world outside the U.S. and emerging markets. Investors are looking for high returns because they're investing in risky emerging markets, and so they figure that those should come with high returns because they're risky, that capital is loaned out at very high rates, and they just aren't. I mean, the borrowers aren't able to pay those rates. And it's been really devastating. There's stories of farmers in particular in some developing countries, just suffering greatly, and their families suffering greatly under this mountain of debt that they've taken on inappropriately. So when that kind of instrument gets labeled as impact investing, it hurts the whole field. So I think that's also a barrier. I don't want to say there's that's the norm. It's not. But even where those are exceptions, once you have stories like that, it raises questions and lack of trust and all of those things in the terminology around impact investing.
So Lisa, in Colorado, there's a group, the Social Venture Partners International out of Colorado Springs, that they did a $10 million challenge, which was essentially to raise 10 million so that they could solve for something in particular that was a pain point. And they decided they would reduce the carbon footprint of the fossil fuel generation, power generation in their region. And so they brought the local impact investment sector together to really think about how do you solve for something that is a pain for us. How would you see that kind of approach working in Idaho, specific to the Treasure Valley?
I think there's a lot of potential to raise money, whether it's philanthropic or whether it's investment money, around that kind of cause, or elimination of pain, or whatever you want to call it, or solving a problem. I think there's a lot of opportunity for that. In terms of an investment vehicle, if it's going to have a financial return, it has to have some revenue source attached to it. And so it depends, sometimes the solutions need to be, completely philanthropic, or they need to have a philanthropic piece next to them to make them, sort of fit. And a lot of impact investing is done that way, in partnership with grant money. And then there's an investment piece that can be much bigger than the grant money, because there are more investment dollars available. So it remains relatively untapped. I know we and lots of other people have sort of started poking around this sort of place-based investing idea.
Mm-hmm.
It's still there. We keep poking, but not enough. It's still there.
What would it take to really bring the right people to the table to begin the dialogues around something like this? Because I do think that this is when we start getting to more transformational solutions for community, is when we focus our own on something that we can solve.
Yeah. I think, I don't think anyone's answered that. I want to say that there are a number of place-based funds out there, but not a big number. It's a small number.
Right.
The example you just gave in Colorado Springs, with which I'm not familiar, I think there are more and more of those, but there aren't a lot. I would say the very first thing that a group in Idaho wanting to do that should do is find another city that's done it recently and do what they did, right? Yeah. And so we've worked a bit with a group called Mission Driven Finance that's out of San Diego, that's done, that's catalyzed some place-based investing there in really interesting ways. And they may be able to bring, we've talked with them in a very cursory way so far about what could we do in Idaho? Is there a model here? because they know the pieces that it needed to get off the ground in San Diego. You know, there are other examples, but the other thing I think that's needed is, you know, is some resources to start with, which are not just money, but also, you know, some bandwidth, some human resources, because this would not be quick, and it would take some, you know, significant work.
Yeah.
But huge opportunity, absolutely. And I also think that there's some savvy people at the city of Boise that have also been thinking about looking at that. And I also think the CDFIs, you know, might play a role in catalyzing something like that. I'll mention one other thing, which is in other communities, the Community Foundation has been involved in helping to spur interesting types of impact investing, or to be an investor in some of those vehicles. Usually there's a CDFI and the Community Foundation involved in those types of things. I've only witnessed them, so, you know, from afar, so I don't know the details, but yeah, cool stuff.
Well, you know, it's if we're going to solve some of these intractable problems, we've got to come up with different solutions.
Absolutely.
So
Yeah. And tons, as I said, tons of potential, because we haven't done it doesn't mean we can't do it.
exactly.
Yeah. And I, you know, I would love to be part of those conversations. I don't think I can lead that because I'm leading this other thing. But I absolutely would love to be part of that.
Great.
And help however I can. So
Perfect. Yeah. I think I've asked my quota of questions.
they're great ones. Wonderful.
Well, I've learned a ton. And every time I lean into this topic, I learn more, and I see the possibilities of these types of tools to really accelerate much more transformational change when it comes to bringing people together to leverage their resources differently to actually help solve something. Yeah.
Oh, great.
Yeah.
Great.
Yeah.
Wonderful.
I'm
And
going
if,
to throw it back to you, Lavanya.
yeah, and if nobody else has any other comments, we'll just close with that note from Blossom. And Lisa, thank you again for that wealth of knowledge. I made so many notes. I have to go back and look up things. And we definitely hope to connect with you, and to everybody who joined us today. Thank you so much.
Thank you. Take care. Bye-bye.